Hello again, everyone, and welcome to Saxo's Q3 Quarterly Outlook webinar. I am Charu Chanana. I'm a market strategist with Saxo Singapore, and I'm joined today by my colleague Redmond Wong. He's from our Hong Kong office. And as you may have already seen, I think it's been 2 weeks now that we published our Q3 quarterly outlook, and the topic really is AI or artificial intelligence. So we are going to discuss that on this call today, but also more broadly on where we are in the cycle and what this means for the different asset classes. I will just start this presentation by sharing my slides first. And just give it a few seconds for you all to be able to see my screen. Yeah, I think it's there now. So just a word of disclaimer before we go ahead. Everything we say today is for your knowledge and for your information and should not be treating as trading advice. Also, if I may add, we do have the option to take Q&A at the end of this webinar. So you will have the option to drop your questions somewhere on the top right corner on your screen, I guess. Please feel free to do that at any time during the call, and we will try to get to as many of them as possible at the end of this discussion. And yeah, moving along. So yeah, like I said, this quarter's topic is mostly around artificial intelligence. We have tried to dig into this AI theme, which has obviously been a big rage in the markets recently. Every company, every person's been talking about it in some form or the other, and it surely is a revolution. It's bound to change our lives in many ways. But when it comes to investing in the theme of AI, it has become a bit tough to say who will be the winners and who will be the losers. Um, Given how extensive the discussion has been on this, like I said, every company has been talking about it. So the only thing that's pretty clear to me is that Nvidia won't be the sole winner. Obviously has been the biggest gainer so far, purely because of this theme. But I think markets have obviously quickly priced in the positive impact of AI in information technology, but the benefits of AI into other sectors are somewhat still underpriced. And I think that's what we kind of try to uncover a little bit today, and obviously more broadly as well in our research and our articles across the Saxo platform. In this outlook, we discuss the good, the bad, and the bubble of AI. So the good really being, how it brings tailwinds to productivity. It brings cost savings that could boost profit margins for a lot of companies, especially companies with higher staffing costs or a large share of tasks that could be automated will stand to benefit the most from this theme. But again, of course, there are also risks that some of those companies who do not adapt to this trend could be left behind. There are risks that a lot of white collar jobs could be at an increased risk of automation. So I think we touch upon that a little bit as well, and we talk about the bubble, which really means that the valuations of some of the stocks has obviously reached bubble territory because of all the hype around AI. So we get a reality check around that as well. But like I said, I mean, of course, market dynamics beyond AI are also very interesting to talk about. Still very confusing indeed. We've been seeing inflation slowing down, and we've talked about the economy staying rather afloat since the start of the year, when most of the analysts on the street were talking about a recession. No doubt, we did see some risks of a credit crunch last quarter, but those risks have not materialized. The risks around the banking sector have not really materialized. And now, of course, we've seen global economy, specifically the US economy, coming back to life, and the soft landing and the no landing narratives are gaining a lot of focus. There's still a lot of pent up demand at state level, at company level, a lot of investment demand picking up because of the US Inflation Reduction Act, because of the US CHIPS Act as well. So that's keeping employment levels quite firm as well. There's a lot of liquidity in the markets that is also supported by, the liquidity support that came through following the regional banking crisis. So all of those factors have been supporting equities in several ways, and obviously we've seen a good run higher in US equities over the last several weeks. And AI has had a role to play, but these other factors with regards to where we are in the cycle is also quite relevant. But the broader theme, a structural theme of the fragmentation game is still playing out. It's still key. I think that's something we discussed extensively in our second quarter outlook. And we still see that happening in terms of, the supply constraints that are persisting and what that means for inflation. Of course, which is cyclically slowing now, but where does it settle? Does it come back to the 2% levels, or it settles a little bit higher than that? I think that fragmentation theme has a big role to play in our views around that long-term inflation expectations as well. And I think as we go along in this discussion today is just a broad agenda that I'm sharing today. And some of these are the questions that we've been regularly getting from, clients and people we speak with, be it media or our viewers and our several, channels. And, when we talk about equities, I think the biggest discussion point right now is how long can that resilience that we're seeing in US equities last, or what is it that can really disrupt the rally there? When we talk about FX, the USD movements have certainly been quite massive last week. And, is that the start of a long-term dollar downtrend? And then what are the risks that a potential tweak from the Bank of Japan could bring for us? We have obviously some slides on commodities as well. And our chief commodity strategist, Ule, has written the quarterly outlook piece, and he talks about whether we've already seen the bottom in the commodity sector, and is it, where do we go from here? And we talk about some of the commodities that are going to be structurally very important in the economy going forward as well. When we talk about fixed income, the question that we've been getting from clients a lot is about, is it the time to add duration and to, kind of move into the long end of the yield curve as well. And we obviously discuss and how to kind of diversify our portfolio and what are some of the opportunities, especially with China slowing down and with geopolitical tensions being, at the center stage. Regionally, we see a lot of opportunities in Japan and in India, and we're going to touch upon that a little bit as well. So, with that, I think I'll just pass it on to Redmond, who will take you through our views on the equity markets in more detail.
Thank you, Charles. Year today, I hope you are seeing my screen now. And the NASDAQ definitely outperformed and up more than 40% year to date, and outperforming the MSCI World, and also the S&P is 15%. And the equity is really AI related, and also semiconductor. And on the right hand side, you can look at the performance of our equity theme basket. You can see semiconductors rank at the top. And later on, we have also breakdown for AI theme, and that's also have a year-to-date performance of 42%. And it's really, yes, it's really a high concentration in the performance. And you can see that because of the very good performances in some of those market cap, and the S&P concentration ratio is a measure of how concentrate those large stock in the index has actually come to a multi-decade high. And on the right-hand side, you can see the table showing the recent rebalancing of the NASDAQ 100. And before the rebalancing, which will take effect on the 24th of July. So until now, still, and the top 7 stock in the NASDAQ 100 represent more than 50%, more than half of the index. And you have Apple is at 12% and Microsoft 12.8%. And so that is, of course, that requires some rebalancing the trend. But even after the rebalancing, the top 7 stock still account for 44% of the index. And you can see many are actually related to AI, and even Amazon has the cloud computing has very good potential for AI application, because you need a lot of computing power as well. So, but of course you have Microsoft and Alphabet are the two, and NVIDIA, of course, providing the chips for AI, the GPUs for training and so on. So the lower table on the right-hand side is just give us an idea. Some of those stocks might be benefiting from this rebalancing slightly, and these are the next 10 stock in terms of the weighting in the NASDAQ 100. So after rebalancing, there will be a increased weighting in the index. And we're back to the discussion of AI. This is Saxo's AI basket you can find on our platform. And as I said, year to date, the performance is also above 40%, and over. And then there's more than just the top 7 stock. And of course, you can see we can break it down into hardware and computing power. And NVIDIA definitely is top one, and then AMD and is catching up, and also TSMC for their foundry capability. And the software application, you have Adobe, Snowflake, and Salesforce. And the big tech, you have Alphabet and Microsoft and Meta. And as I mentioned, Amazon also have some exposure through the cloud computing power. So based on that, despite all those recent very strong rally in the AI related stock, and we still see the trend will be continuing. Yes, there's risk that they are going into car bubble valuation, because if they are trading, it's really expensive, and unless the growth really have to pick up a lot. But the trend at the moment is still just at the beginning. So I think there's still a lot of money haven't really been in this trend yet. So there'll still be more money at the sideline want to get into the market. I think one of the tool probably investor can consider is, if you have a long position in some of those stock and whether you should be taking profit, I actually should consider some option strategies, and which you can talk to our salespeople here, my colleague in our strategist team. They also publishing some option strategies, call spread and so on some of these names, and that I think that would be useful, and to help to manage the risk at the same time to maintain some exposure in this sector. And of course, we need to be mindful about the valuation, and that is if they have go up again very fast, and then some of them are of course have risk for some kind of pullback. Yeah, but the trend and for AI investing, and I think it still will continue for quite some time. But besides AI, and we still want to reiterate our these 4 pillars in the fragmentation. This is this is from our last quarter and the second quarter outlook, but we think that this is from medium term to longer term play, and we still like defense and electricity, and including renewables and nuclear power. And also technology, of course, is AI, is the theme, and semiconductor, and also energy storage, so batteries. And so especially in the EV theme, we like actually playing through the battery rather than directly into the EV. And physical infrastructure, commodities, and logistics, we think that is a multi-year investment theme, and that's going to last for years to come. So so I think in the portfolio, in the well-diversified portfolio, we think that we should still have AI-related stock, and at the same time, we should diversify to some of these more longer-term kind of trend as well. and including AI and technology, of course. But there's more than just AI and technology, and we should, in a more diversified portfolio, we should consider the other pillars in equities. And in China, and I think on the chart, this is the China's non-financial debt to GDP ratio. Why do I put this up? And because it's over the last 1 or 2 months, we have been seeing a decline or slowing in the strength of the recovery in the Chinese economy. So many investors actually are thinking about and anticipating, have a lot of hope for the July Politburo meeting taking place in China. That's usually the end of July. They do that every half a year, and this meeting they will focus on reviewing the economic performance, and also we are decide the strategies for the next half year. So there's a lot of anticipation that the Politburo, the Chinese Communist Party, the Politburo, the highest governing body, they will roll out some massive stimulus package. We have some doubts on that. One of the reasons is since 2012, and China's interest payment within the whole economy is already higher than nominal GDP growth rate, because the nominal GDP growth rate has been coming down and interest payment is going up, and since 2012. Why do we emphasize that? Because if your interest payment as a percentage of GDP is above your nominal GDP growth rate, your debt to GDP ratio will keep going up. So as in 2016, there's an article in the People's Daily. People think that the offer actually was Liu He, the former vice premier and President Xi's close ally in politics and economic policies. And he actually have an article say the tree cannot grow to the sky. And he published that in early 2016. And in October 2016, the Politburo, again, the highest governing body in the Chinese Communist Party and also in the China, and he say curb asset bubbles and safeguard against economic and financial risk. And then in 2000, and then starting in 2016, the Chinese authorities start trying to deleverage the Chinese economy. First, starting on the shadow banking system, and then later on, we all know, August 2020, that is taking down on the property sector. And now they also have a lot of concern, not just for the property sectors, but also the local government debt. And why the local government debt gone up so much, and why the stimulus package would be may not be really so likely. If we remember back in 2008 to 2010, when China spent 4 trillion renminbi after the great financial crisis globally, and China spent a lot of money on a huge stimulus. And out of the 4 trillion, actually the local government finance or pay 3 trillion of it. So I mean, not the central government. Central government only chip in 1 trillion, and much actually go to Sichuan for the earthquake reconstruction. But for the building infrastructure and spending on infrastructure is actually financed by the local government, and they become highly in debt. And then so we have to think about the Chinese leadership. The target probably will be looking at the stability in China over the next 4 to 5 years, when the current leadership will have another, some maybe in facing some transition, or if they want to stay here, I mean, they of course, they want to ensure stability in the 4 to 5 year terms, not really just in the next 1 or 2 quarters. And then the also important is since 2006, and China's productivity contribution from productivity to economic growth has been slowing down. And you can see, with all those stimulus and so on, I mean, the economy will rebound, but actually productivity growth has been quite sluggish. It's been coming down to 5%. So if only relying on productivity growth without putting in more resources, the economy can grow in real term by 2.5%. So the longer term trend growth in China has come down a lot. I mean, it's in 2005 and 2009, you can see it's around 10%, and then all the way coming down. Even before the pandemic, China's trend growth is already hovering around 5 to 6%, around 6%. So for the first half of the year, we had the number earlier this week, and for the first half a year, and Chinese economy grow at 5.5% year on year. I mean, in the second quarter, 6.3, and the first quarter, 4.5. For the whole 6 months, is a 5.5. So that is pretty much in line with the Chinese government's target for this year, growth target for this year. And also, you can see that's not much. I mean, that's just about the trend growth of China. So without productivity growth, or more resources being put into the economy. I'm talking about real resources, not printing money. Printing money does not raise trend growth, does not raise potential GDP growth. It can only help some kind of very short-term aggregate demand management. But in order to have a longer-term trend growth, you need either putting in more resources, like more people, more energy. China's actually population already peaked last year, and the working age population peaked in 2015, and so it's creating some constraint. And so the trend growth is really is an issue, and it's very difficult for them to. That's why we think that it's unlikely they will do a lot in the stimulus. Okay, I'll quickly go to the internet stock and AI theme in China. And I think recently we have seen some positive headline towards the internet company. And in fact, this trend started, we did argue back in December last year. We did publish this article in December last year, saying that the Chinese government already adopted a more conciliatory, more friendly tone stance towards the private sector, including and in particular, actually, the internet company. And now it's become even more important because it's in order to enhance productivity, in order to become technology self-reliant, and China's need those internet companies to help in the technological innovation and computing power. And like Alibaba, I mean, for AI, you need algo, you need data, you need also computing power. And then those internet companies have the algo. Maybe more companies will develop it, but the Chinese internet company have the data and also have the computing power. Alibaba, Tencent, and Baidu, they have most of the computing power, and especially in the cloud computing, they can provide a platform for other companies to develop the AI algo and do AI testing, training, and so on. So that is not really the specialty for the SOE giant. So China will need internet company at the moment. But very quickly touch upon the challenge because of the geopolitical situation, and that is restriction on the access on them on the semiconductor. So for GPU in inventory, so computing power is quite comparable to the US, but going forward, they will be lagging behind because they will have increasingly difficulties to get access to high-end chips from the US. And I think I stop here and I pass it back to you, Charles.
Yeah, thank you, Redmond. So yes, talking about equities, where of course AI has been the dominant theme, but also I think it's potentially the time to start to get a little bit more granular, especially as we are now at the start of the earning season, and things can be pretty wild sometimes in earning season. So I think start to be a little bit considering options as well, like Redmond mentioned, and then a great overview on China as well, where of course tactically, it probably a selective play still, but there are still some structural headwinds that we need to be cautious about. So I'm just going to start to move towards how we can diversify, as I mentioned in the agenda. And certainly Japan stocks have been very interesting. They've been on a tear this year. It's the second best performing market after NASDAQ so far this year. And there have been plenty of reasons for that. I mean, Japan monetary policy is still easy enough to give stocks a boost. Corporate governance is becoming increasingly friendly to shareholders. Regulatory stance is becoming increasingly friendly to shareholders. There's a massive push for companies to increase their price to book value ratios above one, which has not been the case in Japan for many, many years. So dividends, share buybacks are increasing at a very, very fast pace. So this year, the country's stocks actually broke through their strongest level since the bursting of the vast asset bubble in the 90s. And I think we've seen that with a very broad-based outperformance, as this chart on the right side is showing you. It's green almost across the board. There are hardly any companies that have not taken part in the rally that we've seen so far. And there's a clear rotation, of Asia-focused investors out of China into other regional markets, and Japan has obviously gained because of that. And then there's been a nod from Warren Buffett as well, who's been increasing his investment in the five commodity players in Japan, and he's been visiting Japan, and kind of just sending out a lot of positive note there as well, which has attracted a lot of foreign funds, a lot of foreign investors into the Japanese market. Now, the key question that obviously I've been getting from a lot of clients is about whether the valuation in Japan has kind of reached high, and is there more room to run on this Japan equities trend? So I would just probably refer to some estimates that I saw. Those were from one of the Japanese banks, which they estimated that in the last 12 weeks, we've seen about $43 billion of foreign inflows in the Japanese markets. And according to their expectations, they thought that if global investors raise their exposure to Japan from underweight to neutral, just neutral, not even overweight, we could get another $70 billion to come as well. So I think, so what we've seen probably is just the tip of the iceberg as well. And there's a lot of great opportunities there. And then again, our equity strategist Peter has written several pieces, articles on our website, on our platform, on Japan markets, which sectors could be interesting. But something that I've written for this quarterly outlook particularly is blending these two themes of Japan and artificial intelligence together. So these two have been the most popular themes so far this year. And when you blend them together, I think it kind of opens up a new area of opportunity, which has probably a very long-term, a sustainable trend to come. So let me talk about that in the next slide a little bit. So what I'm basically arguing here is that Japan's expertise in semiconductor manufacturing, in robotic integration, it could be the foundation of its dominance in artificial intelligence as well. We've already seen a lot of steps being taken by Japanese authorities to attract chip makers to set up their manufacturing houses in Japan to take advantage of all this geopolitical upheaval that we're seeing right now. They've given a lot of incentives to boost investment. So not just the Japanese chip makers are moving back production into Japan, but also some of the US players are considering, they're getting subsidies. So they are considering moving their production out of China and into Japan. Now, why there's a good amount of potential for AI to develop in Japan is because of the demographic challenge that Japan is going through. It's an aging population, which obviously brings headwinds to productivity growth that they can see in the medium to long term. So there is more of an openness to adopting AI to be able to do some of those low value added tasks. Whereas some of the other regions where, labor supply is not as big a challenge as it is in Japan, can see a lot of, pushback on adoption of AI as well, which is not the case in Japan. Japan also has a lot of AI skilled labor force, as you can see in this chart here. They've had good participation in the first and the second phases of artificial intelligence development as well. So their labor force is kind of, quite advanced in that sense. And a lot of firms in Japan have excess cash on their balance sheet. So they have the flexibility to deploy that cash in research, which could, again, could go into AI research particularly. While globally we are in that environment of high interest rates and high inflation still, which obviously continues to constrain spending from companies a little bit globally. So I think there's a huge amount of potential that this marriage of robots plus AI could bring in terms of productivity gains, as well as in enhancements in labor and global trade as well. So it could be just a new economic era for Japan if it was able to make these advancements in AI faster than some of the other countries. So I think I've just listed here on the right some of the interesting players in that space in Japan, in among the various subsectors of AI, as you could call it. There's some ETFs as well that are purely focused on Japanese semiconductors or Japanese robotics and AI. So they're up for your consideration as well. And I think overall, like we've Redmond's talked about, I've talked about, the fragmentation game is still the underlying structural theme that's playing out. I think, and that again brings a host of opportunities to diversify portfolios regionally, whether be it considering Vietnam, which is obviously a huge gainer of all these shifts that we are seeing in supply chains, or even Mexico. The Vietnam and Mexico certainly seen a lot of interest because of a lot of supply chain shifts that are happening. Indonesia has seen a lot of interest because of the massive amounts of reserves it has for the green metals, lithium, nickel, for example, which are much needed for the green transformation for your EV batteries, and everywhere where you see scope for refitting of those energy supplies. So I think that's the broader theme that's still playing out, and China is certainly losing on that front. So this chart on the left is showing you the equity performance on a relative basis of China versus these other countries that are potentially the winners of this fragmentation or theme that's playing out. These include, Mexico, South Korea, India, Malaysia, Japan, Indonesia, and Vietnam. And I think it's clearly showing that whatever stimulus measures, of course, Redmond said that his expectations of stimulus measures are not very high, but whatever stimulus measures China can do will continue to still, be offset by the challenge that structurally China is facing because of geopolitics and because of this play out of the fragmentation game as well. And the winners, as I've highlighted, these are the ones on the right hand side. Some of them, and some of the ways ETFs that we can use to get exposure to them if you kind of believe in this fragmentation game and want to play a part in terms of investing for the long term with this. And the other key player that we've been talking a lot about recently has been India, and India has always had these long-term structural tailwinds of demography, of rising urbanization, of a growing middle class. It's obviously now the fastest-growing economy as well in the world, and those who have missed out on the returns so far this year has. A lot of them have been now forced to reconsider, to rethink their exposures to India. And we've been getting a lot of questions from clients, from media, and everywhere. And we've been writing a lot on India as well on our platform and on our website. So a lot of investors, like I said, are also they're faced with this dilemma of where to go after China has stopped offering the same kind of alpha in their portfolios as it used to at one point in time for many, many years, in fact. And the clear answer has only been, India so far. India has seen massive digital adoption in recent years. It's now also trying to make some strides in attracting manufacturing with government measures aligned to, attract to offer subsidies to attract manufacturing to take advantage of the current tremors that we're seeing in the geopolitical world as well. So there's a key long-term opportunity And on top of that, India exposure also offers a lot of diversification benefits to portfolios because of its low correlation with global indices. So, like I said, there's a lot of research you can find from us. I've written this article, put a snapshot of that, India investing for the next decade. It's on our platform. We've done an episode of on India for the curious investor. In case you've not checked that out yet, the Curious Investor is our latest video series. It dives into various topics that are relevant in the investing world. So do check that out on our YouTube channel as well. We have many different topics covered there. We get out a new episode every week. I think one should be going out today as well. And we will be going, and we have done one full episode talking about the opportunity in India, which sectors are interesting, and how do you get exposure to that in one of those episodes of The Curious Investor as well. And on the top right here, I've also shown Saxo's India Growth Theme Basket. Although, I mean, I would still say that India is a very broad macro story. So even an index exposure could be a good way to kind of participate in that massive growth that's coming through into that country. But of course, you have to be mindful about FX risks and hedge that in some way. But yeah, I think an index exposure is a great way to kind of cash in on this growth story. But if you're looking at specific sectors and specific stocks, these stocks in the India Growth Theme Basket are some of the stocks that are Indian stocks that are listed in London or in New York. And these are also, I think, pretty representative of the broad macro story that's playing out, a positive macro story that's playing out in India. Jumping on to FX, yeah, like I said at the beginning of the discussions here, that the big question has been around the path for the dollar from here. And treasury yields and the dollar trajectory did take quite a substantial turn over the last week, with economic data out of the US proving to be quite resilient, inflation slowing down as well, quite substantially. And we've seen dollar longs having evaporated very quickly, and there are some calls for a long-term downtrend in the dollar picking up as well. For me, I mean, I'm not convinced about that long-term dollar downtrend. Certainly seems like there will be some pressure on the dollar in the near term. But our sense overall, when we talk about where we are in the cycle, we still think that structurally, like I said, inflation is going to continue to surprise us on the upside. Investors may have positioned for the end of the rate hike cycles somewhat prematurely. And obviously, especially for non-US, economies, major economies other than the US, recession risks remain quite pronounced as well. So far, I mean, of course, dollar has been selling off a little bit, but because ECB and the Bank of England continue to be a little bit more hawkish than the Fed, which has obviously seen inflation come down quite a bit. But in terms of the monetary policy path from here, and we've seen that very recently as yesterday, with ECB starting to tone down on its hawkishness, because of the economic risks that are there. So economic risks are, like I was saying, is certainly more for Europe. It's certainly more for UK as well. And now, if they have to still up their hawkish rhetoric because inflation is not getting under control, that will spell panic, it will spell desperation, and it may not necessarily support their currencies. And we've seen that already in the case of sterling, when last month's inflation data was higher than expected, and we saw a markup in expectations for Bank of England's rate hikes, but that did not support the sterling. It was a situation of panic. So I think that's the situation I'm worried about a little bit. I'm worried about economic risks in Europe and in UK as well. So I think that will mean that a persistent threat of inflation, if there was in the US, that will still leave scope for the Fed path to be repriced higher a little bit if it had to be. And even if the dollar is becoming less yield sensitive at this point, it is an insurance for recessions, and especially if it's a non-US centric recession, you still need a kind of an insurance, and that's going to be a safety bid would potentially come into the dollar. So I think that still means to me that despite this near term headwinds that are there in the dollar, I think we have to be mindful about calling it a long term downtrend for now. But of course, I think something that's very important is to consider the yen path, and it is something that we will need to constantly monitor in this quarter as well. After we saw the Japanese yen printing some fresh lows, now we've seen USD yen going lower in the last week or so. So the yen has made quite a bit of a recovery in the last week. The most obvious driver of the weaker yen, as we all know, in the second quarter when we saw the weakness in the yen, it was the fresh widening that we saw on the policy spreads. Central banks globally continuing to tighten, but Bank of Japan still sticking to that easy policy, dovish rhetorics, and maintaining its policy interest rates in the negative territory as well. Now, our expectation when it comes to U.S. specifically, growth and inflation still remaining quite high. So that obviously does mean that the yields elsewhere could continue to pose a challenge for the Bank of Japan. Certainly, I mean, the pressure has come off in the last week, but like I said, there's always a risk of that inflation settling in higher, and that continuing to bring or continuing to limit the downside in treasury yields, and that will continue to pressure the Bank of Japan. But of course, I mean, after its first meeting in April, Governor Ueda has declared that he would conduct a policy review lasting for maybe 18 months. That's clearly a very long timeline, but certainly wage pressures are a big focus for Bank of Japan, and they want to kind of see the wage negotiations next March to kind of make sure that if at all they were to make any policy move, it's justified by those wage growth numbers as well. But again, whether the circumstances, global yields do allow them to wait as long as that is going to be another question. There are very high expectations that we could see a tweak in July. But this week we have the inflation data out of Japan on Friday. That will be, I think, a key input. If we continue to see slowing inflation, there will be, of course, little reason for them to do anything right now. But again, like I said, this is a quarter where we still have to continue to watch it, because if a tweak was to occur, even though it's a low probability event, it's just a very high impact event. A Bank of Japan capitulation could bring kind of a dam break, as John Hardy, our FX strategist, calls it in our quarterly outlook. He says that it could be, I mean, so large that it could drive significant contagion across global markets as well. So just keep that on your radars. And Redmond, I think it's over to you to cover fixed income.
Okay, now I'm on mute. Sorry, just lost my cursor earlier. Okay, yeah, I think this chart is just the different measure for U.S. Inflation rate, and the blue line is the 2-year U.S. Treasury government yield, and I think in the last quarter and last 2 quarters, we have been here at Saxo, we have been saying that we did not expect a recession. We think that the market has above what they should be, and so I think that one, I think we got it right. I think we can get ourselves a pat on our back, and there was so far there's not been any recession, and structurally, yes, we are expecting inflation rate. Inflation will be the trend in long term will not go down to 2% anytime soon. But having said that, cyclically, inflation, we also at the level of 6% level, and now back down to between 3 point something to 4 point something, depends on what measure you are looking at. And that trend probably in the next few months will still be continued. So we think that the Fed most likely will, yes, I mean, it's pretty much 25 basis point on the 26th of this month. It's a done deal. But September, probably they may not do it, and maybe we have seen the peak for the rate in the near term, and even for this cycle. So even inflation rates coming down only very slowly, and as long as it's not shooting up again, given the risk, I mean, other consideration, and also the functioning of the treasury market, and also the banking system, all those, the Fed is going to stay put. So when we say all this is because that we say the 2-year treasury notes is really at 4.7% become something valuable and interesting and may be considered to be part of the portfolio. And we are not, so I think that might be advisable to move some of those money from cash to 2-year. We are not calling for to really to go to the very long end of the treasury curve or the yield curve, because it's we think that usually when the Fed pause, the curve will steepen, i.e. long short-term rate will come down faster, and long-term rate sometimes come down less uneven, going higher, depends on the outlook of the economy and the inflation rates. But the short-term rate is very much dictated by the Federal Reserve policy over the next 1 to 2 years, so that will have more room to come down, because the Fed probably will put on hold, and that is still some chance, even though as I mentioned, we did not expect, and we are not expecting a recession, and we think that we got it correct in 2023, but we will not rule out some slowdown or even recession in 2024. I mean, this recession is something like day and night. It will come eventually after some years, but I mean, we just think that at the moment the U.S. economy is still very resilient. So, holding some treasury is not a bad insurance in the portfolio. And of course, if I may, I just go back a little bit to the stock market. I mean, we still think that. I think over the last quarter, I think if you listen to us in the last quarter, I think we think that is when many people expecting we will first see a new low in the stock market and then go up in the second half. Actually, we took the contrary view. We thought that the stock market actually did good in the first half, maybe the best during the first half, and because we did not see a recession, but that may be a little bit more flat in the second half. And so we think that yes, and we still think that the stock market, we should have some exposure to the stock market. We think that it's still the trend is still going up, and but that would be may not be seeing as like a stellar performance as in the first half, and that it will be getting more difficult towards the end of the year and early next years. And if the economy really slow down a bit by that time, and if with the stock market even at an even higher level, and so we are constructive in stock, and so the bond is good to have as for a diversified portfolio and as my insurance. So we emphasize that we were just looking at the 2-3 year sector, and also looking at the rather high quality and name, because it's the high yield. I mean, even though we are not seeing a lot of risk there, but the additional yield you can get from high yield is not really historically, it's not so high. So we prefer to stay with the highly liquid, high quality 2 to 3 years, and as a good diversification for that in your portfolio. And Charles, I think I'm done on the bond, and I pass it back to you.
Thank you, Redmond. So yeah, let's jump over to commodities now. So like I said earlier, again, commodities, we still see a structural bull case despite some near-term demand concerns. The commodity sector is already starting the third quarter on quite a firmer footing after months of weakness. We saw that reverse in June, and then the first 2 weeks of July were also positive overall for commodities. And in the outlook, like I said, Ole, our commodity strategist, has been asking whether the commodity sector was bottoming out following a year-long decline. While there are some some potential negative drivers still in the pipeline, we are seeing some emerging signs across the different sectors and commodities that are pointing to support as well. Structurally, the themes of fragmentation, the themes of green transformation, they're all supportive of a stronger, rally in commodities generally in the medium to long term. And if I just touch upon some of the key commodities that we're looking at for this quarter, again, I think it's the top one has to be gold, following the strong run up in prices that we saw in gold since November. Most of the second quarter for gold has been pretty range bound. It has been consolidating. It briefly reached obviously a fresh record high, but then after that has been consolidating quite a bit. Sentiment currently is challenged by the recent rally that we are seeing in the stock markets, and the prospect of additional US rate hikes as well, which has delayed the timing of a gold supportive, peak in rates. So once we see that Fed rate peaking, that's the time when a gold rush really begins, as showing in this chart here as well. And this is a chart that we've used repeatedly across our webinars and presentations in the past because it's just so interesting. It shows how every time the Fed paused in the last three cycles, gold rallied, and the rallies have been of the order of 56% and 186% and 62% respectively, in the last three times that the Fed paused. So I think that once we get to a Fed pause, the story for gold is going to look very different. But of course, short term points to further consolidation below that 2000 level, because but overall, I mean, like I said, we still have this bullish outlook because of the continued dollar weakness, because of a potential slowdown in the economy, because of safe haven demand for precious metals, because of a lot of central bank support as well. Some banks like Chinese central bank have been buying gold a lot. So I think those are some of the supportive factors for gold, and just the overall fragmentation theme is also this multipolar world kind of continues to raise the geopolitical temperature, in which case you need a safe haven asset, and you also need something that reduces your dependence on the US dollar. So I think that's why gold is seen as a very good diversifier in portfolios. And I think copper again has been pressured quite a bit because of the weakness in the Chinese economy and the lack of stimulus measures as well in China. But falling inventories, this is a chart of inventories of copper at exchange monitored warehouses, and that's kind of nearing a 5 month low, which is helping to trigger a change in sentiment from hedge funds who up until now have traded copper with a little bit of a short bias. But I mean, our sense really is that whether we get additional China stimulus or not, the current copper weakness is potentially still temporary because of the green transformation theme that will continue to provide strong tailwinds for all of these green metals, but particularly for the king of green metals, which is copper. It is the best electrical conducting metal. It is needed in batteries and electric motors and renewable generation, in energy storage and grid upgrades and stuff like that. So, and like I said, the inventory levels are not sufficient to be able to meet this growing demand. So I think, and there are a lot of production costs. There are the ores that we have for copper right now are also very low ore grades. There's a lot of threat of climate change, of government intervention as well. So I think that kind of keeps the supply forecast a little bit more restrained. But for demand, there's no restraint on copper demand that can come from that green transformation. So it's still a bullish story for us. And the other commodities, particularly for this quarter, which will be very important to watch, are the agricultural commodities, and markets are on a high alert uh, for two specific reasons. One being the return of El Nino, which has been, it's formed a month or two earlier than most El Ninos, and it strongly tilts Australia towards drier and warmer conditions. Northern countries in South America, particularly Brazil, Colombia, Venezuela, they're likely to be drier as well. But the southern countries there, Argentina and parts of Chile as well, likely to be much more wet. In Asia as well, we see the impact going into India, into Indonesia, and a lot of other Southeast Asian countries as well, which tend to be dry through August in El Ninos. So basically, just a lot of change in climate patterns, which makes it very hard to predict what kind of a supply you can have of these agricultural commodities. And on top of that, now we have Russia drawing out of that Black Sea deal, which challenges supply, which kind of restricts the supply of agricultural commodities that we can get out of Ukraine, which is one of the biggest suppliers of most of these key commodities. So, adding the weather woes to this Russia issues, I think it's really important to keep an eye on the vagaries in the agricultural commodities for this particular quarter, and I think that's a wrap for us. Just finalizing some of the themes that we discussed in equities. As Redmond mentioned, we see opportunities beyond the narrow leadership or the concentration in equities. It's time to be granular in your portfolios. Going into the later part of the tightening cycle, it's also still good to be defensive. REITs is looking like an attractive play, and we have an episode on that too coming in our the Curious Investor channel in the next few weeks. So I think stay tuned for that. Oh, sorry, REITs is already out. My bad. We already published the REITs episode last week. So yeah, go and take a look at that on our YouTube channel as well. But beyond that, fragmentation game has increased the benefits of regional diversification, and that's something that we should strongly think about. Maybe Japan, India, Southeast Asia, looking like to be the key beneficiaries of fragmentation. China may be a selective and tactical play for now, but you have all these other key markets that could be some more structural plays because of just the whole tectonic plates shifting. Redmond has also highlighted the opportunity in two-year treasuries, while commodities again is still a good structural play as well. And I will just stop there. And I think we're quite a bit over time as well. So I'll just, this final slide, I'll just talk about the key ways that you can still access our research whenever you like. You can go to our platforms, you can go to our website, but we have a daily podcast and a weekly episode of The Curious Investor, as I've mentioned a few times as well. Okay, just taking a look to see. We have a few questions, but we've mostly covered these in our discussion today. So I think we leave it there. And a very very big thank you from both Redmond and I for being a part of this discussion today. Thank you. Have a good day.